Good morning, everyone. I am Maria Cristal Mandigman and I will be your presenter for today. Now we're going to discuss about the working capital management. The contents of this video will include the following: the definition, the importance, components, and the sources of funds within the company. First, we must learn what working capital is. It is a capital which is used by a business in its day-by-day operation. Working capital is equal to current assets minus current liabilities. Also, working capital refers to a firm's investment in short-term assets, short-term securities, accounts receivable, and inventories of raw materials, work in process, and finished goods. However, if we are talking about the management of working capital, organizations must establish a proper optimal usage of their current assets and current liabilities in order for them to maintain short-term operating costs and short-term debt. It is also the process of planning and controlling the level and mix of current assets of the firm as well as financing these assets. Proper management of working capital is essential to a company's fundamental financial health and operational success as a business. A hallmark of good business management is the ability of a firm to utilize their working capital management in order for them to maintain their balanced growth, profitability, and liquidity. Here are some key takeaways that you can remember before we can proceed to the next part. First one, the goal of working capital management is to maximize operational efficiency. Second, efficient working capital management helps maintain smooth operations and can also help to improve the company's earnings and profitability. Third one, management of working capital includes inventory management and management of accounts receivables and accounts payables. Next, we're heading to its importance. Why do you think there is a need for working capital management? First, it will determine if your firm is financially stable. Potential investors verify the firm's working capital management system with the help of various ratios as it reflects the firm's operational efficiency. Second, you can determine gaps or lapses in your operational areas. It helps identify any problem in the key operational areas which are directly involved with any of the firm's profitability. And third one, you can identify if you successfully met your desired goals. It may be short-term or long-term goals of your business. Moreover, a company needs to maintain a desirable working capital to meet its financial obligations to avoid financial insolvency and potential bankruptcy. If you have some additional ideas or insights about the importance of working capital management, you may comment it down to share with our classmates. Now, to further understand our topic, I have inserted a 2-minute video about the credit policy.
The firm's credit policy, which is under the Chief Financial Officer or the CFO's control, is a set of rules that dictates the flow of accounts receivable. It is incredibly important to arrive at the most suitable credit policy for the firm, since it affects sales, the amount of funds tied up in receivables, and bad debt losses. The CFO must set a credit period, the length of time customers have to pay for their purchases. While customers tend to prefer longer credit periods, this is a disadvantage to the firm since it lengthens the cash conversion cycle. Next, the CFO should determine discounts or price reductions given for early payment as an incentive for customers. Third, the CFO establishes credit standards or the financial strength customers must exhibit to qualify for credit. Not all customers are given a chance to pay at a later date. The firm decides based on whether or not the customer is likely to and able to make the required payment on time. Finally, the CFO creates a collection policy, or the degree of toughness the firm will exhibit when enforcing the credit terms. This policy is intended to motivate customers who don't pay their debts on time to do so. Aside from setting the credit policy, it is also important to actually, implement it. Thus, the firm's credit manager must work hand in hand with the credit department to ensure that there is fast, accurate, and updated information. Several organizations actually sell detailed credit reports about specific businesses, while for individuals, credit scores ranging from 0 to 10 are given. These indicate how likely a customer is to default on the required payment. Monitoring accounts receivable outstanding is another of the firm's main concerns. Accounts receivable is determined by the volume of credit sales multiplied by the average length of time between sales and collections. If managers aren't watchful, good customers could start taking longer to pay, and sales could be made to weaker customers who tend to pay slowly or not at all. To monitor accounts receivable, the firm uses the day sales outstanding ratio and compares it to the industry average. Having a great inventory and receivables management system is wonderful.
Now, we have a clear idea on what credit policy is and the approach that a company must make to its creditors. Your business credit policy should clearly outline the sources of data to be used when making a credit evaluation, what data should be collected depending upon the exposure level, and how much weight should be assigned to each element. To be consistent, you should construct a business credit evaluation scorecard so all employees follow the same credit evaluation procedure. This will allow you to feel comfortable assigning new tasks to staff members and feel assured that the process is followed. It will free you for other duties and enable staff to expand their skills. Now we're moving to the 4 components of working capital management, and these are cash, accounts receivable, accounts payable, and inventory. First is cash. The vital element of working capital is considered to be money. It is one of the most valuable components of working capital since it is the most liquid form of fund. Sources of funds can be gained through internal and external sources. For internal sources, we have the profit and sales of assets, and for external, we have the share capital and loan capital, which is considered to be a long term, and leasing, which is considered a short term. Other sources of funds. Under internal finance, we have the following: personal funds, family and friends, working capital, retained profits, selling assets, and investing extra cash. For other sources of external finance, we have the following: share capital, loan capital, overdrafts, trade credit, government grants, government subsidies, donations, sponsorships, debt factoring, leasing, hire purchase, debentures, venture capital, and business angels. A business angel or angel investor is a wealthy individual who invests personal capital in startup companies. They invest in return for an equity stake. In other words, when they invest, they obtain a percentage ownership of the startup business. Second component, we have the accounts receivable. It is owed to a business by their clients for the sales of goods. Examples of accounts receivables are commercial papers, acceptance letters, and of course, treasury bills. And always remember, encashing the account receivable is necessary for maintaining the liquidity in the business. Third component is the accounts payable. It is the amount the company must pay out over a short term. Companies may delay payments. as long as it is reasonably possible with the goal of maintaining positive credit ratings while sustaining good relationships with suppliers and creditors. If the company builds a strong brand reputation and convinces the creditors to provide a longer credit period, it can initiate a better working capital management. And lastly, we have the inventory. It is the company's primary asset that it converts into sales revenues. The measure of a company's success is a rate where it sells and replenishes the company's inventories. Remember, low inventory means that the company is in danger of losing out on sales. But excessively high inventory levels could be a sign of wasteful use of working capital. An organization's ability to control these four factors, the cash, accounts receivable, accounts payable, and inventory, tells you how well it is managed financially and if it is the type of organization you want to put your trust in. So that's the end of our discussion. I hope you guys remembered all the key points and learned something today. Thank you and God bless.